All right, everybody. Hello and welcome to Say That Again. Today's concept, we're going to be talking about the income approach. This is our chance to explain a concept a little bit deeper than we have a chance to talk about in the live online sessions. So today I have a couple of objectives that I hope that we all achieve. First off, I'm going to break down what Say That Again is so that you understand what to expect as we post these videos to the community forum. I'm also going to do a little bit of background information about appraisals and the appraisal process. And of course, we can't have a conversation about appraisals without having a breakdown of what the three approaches to value are. And then we're going to dive a little bit deeper into how you can calculate and approach income approach questions. So we have our PVEON, which is our memory device that helps us break down income questions. And of course, we will be discussing the net operating income, which is something that does come up on exams quite often. And we're going to have a little bit of a review on what capitalization and what cap rates means and how you can use that in an exam environment. And we're going to have a practice problem that we're going to refer to throughout this brief video so that you can see how the income approach works live in an exam, how I would break down a question if I were asked about the income approach. So with that said, we have live sessions nearly every day where we cover topics like the income approach. In those sessions, we have great conversations, and sometimes we talk a little bit faster than what students can take notes. So the point of Say That Again is we will revisit some of those topics so that you have a chance to hear it. And because this is a recorded video, you can watch it several times just to make sure you have the concepts down. We're going to talk about specific topics that students have requested that I say that again. And if you're interested, you can always comment on this video if you'd like to see a future topic on Say That Again, and we'll try and work it into the schedule. So since today we're talking about the income approach, let's start with a common practice problem that you might see when the exam is determining whether or not you are aware or you're able to use concepts with the income approach. An apartment complex has 12 units that pays an average of $1,000 in rent per month. This market has a vacancy rate of 3% and operating expenses of $10,000 per year. The cap rate for this building is 7%. And using the income approach, what is the value of this apartment building? By the time we finish this conversation, hopefully this question will sound a lot less intimidating. If you're not sure where to go with this, don't worry. That's why we're having this conversation now. So why are we discussing income approach? Why are we bringing up appraisal at all? I've heard many students say, we are not appraisers. I'm here to learn real estate. While it is true that appraisers oftentimes have separate training and certifications, we do interact with them on a near daily basis as a part of our business. Appraisers give an expert opinion on the value of property. So since we're in the business of helping people buy, sell, lease property, we have lots of interactions with appraisers. The biggest thing to remember is appraisers have a direct impact on the real estate market. So because they have such a large impact on the market, they are heavily regulated. We never want to give the impression that we are appraisers unless we've gone through that training, we've gone through that certification. We have to have an understanding of what appraisers do because we want to make sure we can clearly explain their work to our clients, right? This is not a course or this is not a process that allows us to become appraisers. It allows us to have conversations with appraisers. The best way to think about it is if you were to walk through a supermarket, but there were no prices on anything you picked up off the shelf. By the time you make it to the register, that person who's ringing up your order might not know what your total is. They might call for a price check. It's very similar with the real estate market. As real estate agents, we're working with our clients in the aisles of the grocery store. We're kind of helping people list and make offers on property. By the time we make it to the checkout counter, that's where the appraiser comes in and does the price check. They essentially issue their expert opinion on value before the purchase goes through. So appraisers are really sort of that last line, which is why they have a huge impact on the real estate market of determining value. Just like a grocery store, as you're walking down a neighborhood, as you're going through a market, not all properties are the same. Residential, commercial, industrial, you have churches, you have schools. So the appraisal process is very complicated to make sure they're addressing the individual needs that each property has. The good news is appraisers have three main tools in their toolbox. They have three approaches they can use in order to figure out the value of any particular property. Now, an appraiser can use the sales comparison approach, they can use the cost approach, or they could use the income approach. Those are the three main ways that an appraiser could give their opinion on value. Now, as we focus in on the sales comparison approach, this is really where you're going to see subject properties that are residential or vacant lots inside of neighborhoods, that sort of thing. Real estate agents actually borrow quite a few concepts from the sales comparison approach to do our own reports, to do our own work with clients. We never issue appraisals, excuse me, but we do still use many of these concepts in our own reporting when we interact with our clients. Appraisers take this a step further, though. They can use the sales comparison approach, but they can also use the cost approach. This is when they're going beyond just a residential property. Sometimes this is a unique property like a school or a church or new construction. These properties don't have a lot of comparable properties in the market. So for that reason, the appraiser starts to focus on how much would it cost to rebuild this property from scratch. Today, though, we're going to focus in on that third tool, the income approach. The income approach is how the appraiser uses a property's ability to generate income to create a value today. What makes the income approach so interesting is it's basically a year's worth of income. And we're going to figure out how much this property can generate in a year. And we're going to use that 1 year's worth of income to create a price today that makes sense in the market. Income properties are typically going to be very large properties. We're not generally talking about single family homes with one tenant paying rent. We're normally talking about office buildings or strip malls or entire apartment buildings, like our example problem. So typically the income approach is dealing with several tenants, several amounts of income, which we're all going to have to organize, which is why we have our memory device. I like to use please vacuum every office now. That's my favorite phrase to try and organize all of the terms and concepts that a student will have to use on the exam. Now, oftentimes when I'm in class, I don't have enough time to break this down fully, so we're going to go ahead and take a moment and take a look at all of these concepts individually. Please vacuum every office now is a phrase so that you can remember all of the different terms and put them in the correct order. The first term, P, stands for potential gross income. The second term, V, stands for vacancies or bad debt. The third term is effective gross income. Our fourth will be operating expenses. And last but not least, we end with our net operating income. The best way to think about these terms is in this order, which is why please vacuum every office now is such a huge help while you're taking the exam. Potential gross income, that's essentially if this building operated at 100% efficiency and made money every second of the day, what is the most money this building could ever make? That's why it's called the potential gross income. It's the 100% efficiency. This building is generating dollars every way it possibly can. We all know in the real world, though, nothing really operates at 100% efficiency. So that's where vacancies and bad debt comes in. That's where we're going to take out money that the building loses when people move out early or they owe you money because they didn't actually pay their rent. That's where the vacancies and bad debt covers those real world examples. When you take the potential money that a property could always generate and you subtract out the real world losses that happen, what you're left with is called the effective gross income. If I was a property manager and I was managing an apartment building, the effective gross income is essentially all the deposits that actually generate off of this building. I would actually be able to find that number on our bank account, and it would be all of the deposits from the tenants paying rent. When I also look at my bank account, I'm going to see some things come off of my bank account, which are expenses in order to run the building. Those are our operating expenses. So you're going to see withdrawals coming out of the account. That's where the operating expenses come in. The balance after I've run this building for a whole year is our net operating income. That's how much money we have when the dust settles. I've brung in all the money that I could through rent. I've paid all the people I needed to in order to operate this building. The resulting balance is our net operating income. So the way we're going to turn this into a formula is we're going to take the potential gross income, subtract out the real world vacancies that happen. The resulting number is our effective gross income. We're going to subtract out any operating expenses we need in order to run the building, and the resulting number is our net operating income. There's your please, your vacuum, every office now. Let's put this into practice just so you can see how it would work with a real question. Remember what we said, an apartment complex has 12 units that pay an average of $1,000 in rent per month. Let's focus in on that first sentence there. We can use that information in order to generate the potential gross income. We're going to take the 12 units that pay $1,000 in rent each month, and we're going to figure out that these 12 units basically generate $12,000 in monthly rent. Be careful, because when we're using the income approach, we have to think on an annual basis. So if you were to take just that $12,000 in monthly rent and you use that in the formula, it's going to throw the numbers off. We have to generate an annual result based off of these tenants paying rent. So even though it's $12,000 a month, we need to take all 12 months of that rent, which then gives us $144,000 in annual rent. Side note, whenever you're doing math, it's a really good idea for you to label your numbers as you're writing out your notes. It kind of helps train your brain on why we're multiplying what we're multiplying. Now we're going to go ahead and go to the next part of this problem. This market has a vacancy rate of 3%. The problem is giving us the information we need to go from please to vacuum. Our vacancy rate is 3%. So when we take our 3% vacancy rate, we're going to go ahead and multiply that by our $144,000 in potential income, which results in $4,320 in vacancies and bad debt. We're essentially saying the building is losing $4,000 because people have moved out early or they owe us rent, that sort of thing. Because the building is losing that amount, we never collected the full $144,000 we possibly could. So for that reason, our effective gross income drops down to $139,680. That's potential minus vacancies equals effective gross income. Now that we know how much actually came in, that's our bank account, that's the actual deposits that made it into the account, we need to take into account all of the withdrawals that came in. And the problem tells us that as well. It says operating expenses were $10,000 a year. That's actually really good to operate a building this size. So we're only losing $10,000 in order to operate it. Since we're having $10,000 in operating expenses, our net operating income will be effective gross income minus operating expenses, which gives us $129,680. Remember what I said, try to label these numbers. It'll help make sense in your mind as you're working through the problem. So what is the net operating income? That is 1 year's worth of income when the dust settles. We've brought in all the money, we've paid all of our contractors, our operating expenses. Now this is the balance of the account afterwards. $129,000 would be how much this building generates in a given year. With our net operating income, we've now calculated it. We've used the problem to generate that number, but what do we do with it? That's where we come into this concept of capitalization. The net operating income is 1 year of the property's income. We're going to use capitalization, which is basically like a verb, where we're going to take 1 year's worth of income and turn that into a real world value. How much would you be willing to pay today in order to have access to that 1 year of income for the foreseeable future? That's capitalization. The cap rate is the percentage of your purchase price that the property is going to earn every year. I'm going to pay you today, but I'm going to get a percentage of that every year back. That's the cap rate. If we were to put this back on our example problem, the problem said that there's a 7% cap rate. So what we're essentially saying is your total purchase price, you're going to make 7% of that back each year. Believe it or not, in real estate, that's actually pretty decent to make 7% of your money year over year. Because capitalization is the process of turning 1 year's of income into today's purchase price, the income, and the cap rate are all connected. They're all related. There's actually a formula that helps you calculate this. You take the value of the building, you multiply it by the cap rate, and the resulting number is 1 year's worth of income. If I were to show you this visually, I can show you that all the terms help influence each other. On my chart here, I have the net operating income, 1 year's worth of income up top. I have the property value on the left side, and I have capitalization rate over on the right side. Remember that formula I just explained. Property value times capitalization rate gives us 1 year of income. So essentially, anytime the problem gives you a property value and a cap rate, you know what you need to do in order to figure out 1 year's worth of income. Unfortunately, the real estate exam is rarely this straightforward. Sometimes they may give you the income and the property value, or they might give you the income and the capitalization rate. In that case, this chart is still very helpful for us because if you ever need to move through the circle a different way, we will always divide in order to get to that third term. So for example, at the very top, net operating income, you divide that by the property value, and the resulting number will be your cap rate. If you took your net operating income and divided it by your cap rate, the resulting number would be your property value. You got it. When we bring this back to our example problem that we've been working through, they told us what the cap rate was, and we used the other information in the problem to generate 1 year's worth of income. So if I come back to our example, we know 1 year and we know the cap rate. So in order to make it further along in the problem, we need to take 1 year's worth of income and divide it by the cap rate. That's what the chart shows us. When we do that, we get a resulting property value of $1.8 million. That's pretty up there. But let's think about this in a real world. Let's turn this into a story. How much would you be willing to pay in order to have access to $129,000 every year for the foreseeable future? The answer to that riddle is $1.8 million. According to the market where this property exists, people would buy this property up to $1.8 million. If we check our math with a $1.8 million purchase price, if you're making 7% of your money back each year, that gives us that 1 year's worth of income, $129,000. If you know how much a property can generate in 1 year, $129,000, and you divide it by the actual purchase price, you're making 7% of your money back, or you're making that cap rate of 7%. Hopefully, now that we've made it through this practice problem, the income approach isn't as confusing, but I do have a favor for you all. Let me know what I should cover next. I appreciate you for taking the time to watch. Hopefully you learned something, and you can always come to our live sessions where we have conversations like this. But go ahead and comment below if you have an idea of what we should cover next time. Thanks.